Good evening, ladies and gentlemen. This is Barry Norman on behalf of investing.com and CMS Trader Capital Markets Traders, and welcome to our class on trend patterns and chart patterns. Tonight's class is sponsored by CMS Traders, one of the world's leading platform providers for trading CFDs. You can trade Forex, commodities, stocks, and indices with the CMS platform. Now, because CMS is a regulated provider, I've got to give you a risk warning. Trading Forex, CFDs, and spread betting on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. Now, tonight's class is brought to us by CMS Trader. Now, if you like, you can click on or go to visit www.CMS Trader right now and either click on, when you open up the platform, you're going to see the buy and the sell signal. Okay. If you just click on buy or sell, whichever one you want, doesn't make a difference. You're not actually making a trade. It will open a demo platform for you, and you can try to use their platform and you can use their charts and follow along to tonight's class. You can also see their social media sites right along, as well as monitoring their spread rates. And you'll find out why they are one of the world's leading providers, where there's no dealer intervention on trades, no conflict of interest between the broker and the trade, and they offer multi-language account managers and customer support. On top, giving you guaranteed security, impeccable service, and outstanding education for their investors. You can open up any type of account you wish. You can also trade micro and standard lots. You get free daily signals, unlimited access to their multiple platforms, and you'll get free daily market analysis and technical analysis, and you'll get exceptional execution of all of your trades. Now, tonight's class is about trend patterns and their interpretation, because somewhere along the line we have to start using charts to make smart trading decisions. Technical analysis is crucially important. And even if you trade from fundamental analysis, which is news, headlines, events, that might help you decide what asset in which direction to trade an asset. But that's not going to help you determine where to enter the market, where to exit the market, and where to put your stop loss, where to set your targets. You're only going to get that from technical analysis, which involves studies and price movements on charts. And one of the crucial parts of technical analysis is what we call chart patterns. These patterns show how buyers and sellers have performed in past action and allow us to see these same patterns developing in the current market and predict how the buyer and sellers will respond. Because the psychology of the markets doesn't change that often. So when a same situation arises, the buyers and sellers tend to react the same. So technical analysis refers to the study of financial markets based on price movement. It uses the assumption that the price of a share or a security reflects all information about that price or that share, including market sentiment as well as perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for identification of well-known patterns that emerge in prices. For example, head and shoulders, channels, triangles, and wedges. You'll hear about these all the time. These are the simple names. You'll hear about flags, pennants, teacups. There's all types of things that people have developed over time. But the most common and the most prevalent and the most reliable are head and shoulders, channels, triangles, and wedges. And when you see these develop on the charts, they tell you something about the market psychology and what you can expect. Now, whether you believe in technical analysis or not, whether you want to spend your time learning these chart patterns. The fact is that chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments. Pattern formations do not form a trading system, but rather provide an indication of future trend of an asset as the price breaks key psychological barriers in the form of support and resistance lines. So whether you believe in using RSI and MACD and stochastics and all these algorithmic number mathematical equations, that's fine. But when you see a pattern developing on a chart, okay, it's simply telling you about the market psychology. You can then use it to make some type of interpretation. There are numerous types of patterns, all named according to the shapes of the price graph formed between the support and resistance lines. The general types of patterns include triangles, channels, wedges, and head and shoulders. And these are the ones we're going to look at tonight. Triangles are the most prevalent. We have symmetrical triangles, ascending triangles, and descending triangles. Okay. These are the three shapes that are formed by the support and resistance lines. Okay. But they all form triangles. A triangle is formed between converging support and resistance lines. A negative sloping resistance line indicates a reducing level of profit taking or more uncertainty about the value of a share. With a positive sloping line, the price levels are squeezed into a corner. Once the support or resistance level is broken, the pressure that is built up as a result of the uncertainty is released, and a certain amount of that momentum is added to the price change in the direction of the breakout. So in other words, it's almost common sense, or almost, it's not involved like lots of mathematical calculations. When you see price forming into a triangle, what you're seeing is price forced into this little tight area. So you see price moving up and down, because price moves up and down. Okay. When you can draw a resistance line above and a support line below, and price is pushed into the head of the triangle, it's telling you at that point, and common sense tells you at that point, it needs to do something. Okay. Either the buyers are going to break out pushing the price up, or the sellers are going to break out pushing the price downward. Okay. Now, when it breaks out of that triangle, it creates a certain amount of momentum that can be established and predicted and then used in a formula of where to set your target price and about where to put your stop loss and where to put where to enter the markets, or how to enter the markets. So regardless of whether you're looking at an ascending or descending triangle, okay, you're seeing that price is getting pushed into the corner. Now, what we call these when they break it, okay, are either continuations or they are reversals. Okay, so it depends. Price could have broken out from this triangle this way. If it broke out that way, okay, same thing here. It could have broken out up, but it could have broken out down. Okay. But a certain amount of momentum is added to the price change in the direction of the breakout. The breakout is what it does when it breaks out of the triangle, either through its support line or its resistance line. But it's the formation of the triangle that you have to be watching for. Now, there are specific variations of triangles that can occur, namely ascending or descending. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. They're virtually just the opposite of each other. So here we see an ascending triangle, and here we see a descending triangle. Now, in a descending triangle, we're going to expect the price to break out downward, but it can break out upward. Okay. In an ascending triangle, we're expecting price to break out. Now, the more conclusive, the stronger the formation of the triangle, the stronger the reaction will be. Like here, if we see this beautiful triangle at the top, look at the reaction of the breakout. Oops. Okay. Here we have a beautiful breakout downward. Here, when we don't have a hard ascending triangle, because we have more of a congested triangle, then we don't have a hard breakout. We still have the breakout, and we could have traded at that breakout, but it's not as strong. So a lot of times we want to look at how strong the trend line is. Now, to use triangles to trade, the distance, and I forget the name of it, there is when when we studied math in college or in high school, there was a name for this outer side of the triangle. But it's this horizontal line, this vertical line. Okay. If you measure the distance between where the triangle ends and get this distance, the breakout will be expected to project up 1.5% or 1.5 times of the original side of the triangle. Okay. Now somebody just asked me a question. Guys, I won't have time for many questions because we won't finish class. But somebody asked, at what time frame would it look good to look for these kind of formations? You've got it completely backwards. You're not going to look for this type of formation by changing time frames. Your time frame that you're looking at is based on the type of trading you're doing. So if you're trading, if you're a swing trader and you're looking at 1 day or 1 hour charts, this is where you would find it. If you're a short-term trader or a day trader and you're looking at 15 or 30-minute charts, because the time frame must suit your trading style and strategy. You're going backwards when you're trying to find this triangle to force it to break out and to fit your trading style. You don't go backwards and you don't take your trading system and your trading strategy, and if you're using a 15-minute chart, go back and look at 2-hour charts and see if you can find a triangle. Because when it breaks out, okay, and you're looking at a longer term time frame, it's going to also fit that type of trading. So if you're doing swing trading and you're looking at a 1-day chart, well, yes, that asset may break out and reach that 1.5 upward level in 30 or 45 days from now. But if you're doing day trading, that's not going to help you much. So the formations you're looking for are based on the chart you are using or the time frame you're using to trade. Okay. So it's not something you don't want to force the issue. Okay, now, once we have triangles, we go into channels. Okay, we're not talking about how to trade from yet. We're just talking about the formation, recognizing the formation. And you don't have to even remember the rules. You just have to simply be able to see, oh, look, I see a triangle on my chart, so therefore I'm looking for a breakout. Because rectangles and channels are virtually the same as triangles, except in a rectangle you have horizontal support and resistance lines, and in channels you have matching downward support and resistance lines. But each one of these patterns tells you how price is going to act and react. And again, we're looking for the breakout. So when price is trading in this channel and it's bounced up and down several times, we're waiting for the price to break out of that channel or in a rectangle. So similar to a channel, a rectangle is a pattern formed between horizontal support and resistance lines. Okay. What you're looking for is a repeated pattern. When you have a repeated pattern, you can then predict what's going to happen based on how the markets have reacted historically to these repeated patterns. So here in the little sample on the right, here we have a nice upward channel and price broke out. Okay, it broke out and had the momentum of the breakout, and then it slowly recovered to where it was trading and returned back to its uptrend. But we could have traded that breakout. And that's the whole idea. You're trading the breakout, not the future price. Okay. Now, rectangles and triangles are sometimes referred to as flags and pennants. Okay. Now, a lot of people and a lot of literature you're reading will talk about flags and pennants. I use rectangles and channels just like I use wedges and triangles because they're just simple visual formats. When you get into flags, pennants, teacups, and all these other names people have given this stuff, it can get really kind of weird. They're still the same thing. A flag would be defined as a bullish continuation channel down or a bearish continuation channel up. So if you have a channel moving up, then it's a bullish channel. If you have a bearish channel, it's a channel moving down. So in other words, it's pretty easy to see. Okay. So basically you have a channel down and we're expecting a bullish breakout. Here you have a channel up and we're expecting a bearish breakout because you're expecting it to react or break out opposite of the trend. Now, like I said, it can then return to the trend line, but it's just a name given to them. It's just easier to call them channels. And then you have wedges. Wedges do the same thing. They're very almost identical to triangles, except they don't converge into a final point. Wedges are similar to triangles in that these patterns are formed between converging support and resistance lines. Now, these are not the horizontal support and resistance lines you draw on your chart. These support and resistance lines come from using swing highs and swing lows in price movement. And when you draw a line between the swing lows and the swing highs, you get, when you draw a line over top, say it's an uptrend, you find the swing lows, the swing highs, and you draw a line forward, and then you find the swing lows and you draw a line forward. You've now drawn two support and resistance lines on there. And if they form into this channel, this wedge, or this channel, wedge, or triangle, that's what you have. Okay. Wedges are the most common wedges are found in breakouts in the opposite direction of the wedge. So what you see here is a bearish breakout in a rising wedge and a bullish breakout in a falling wedge. So before we go into head and shoulders, let's go to a real chart and see what these actually look like on a real chart. So let me pop up a chart on your screen. Hold on a second here. And just hold on one second. I've got to get it popped up here. I have it for you. It's just stuck in the background. Okay. Give me 1 second to get it up on your screen here. Okay, so here we have, there we go. Here we have a chart on crude oil, and you can see here a rising wedge that's been formed. Okay, we see this by, let me get my marker on here for you. So here we've attached the swing highs, and then we've located the swing lows. We've projected a line out, and what we have is this rising wedge forming. So what we're looking for is a breakout in the opposite direction of the wedge. So right now we had a small one, but it moved right back in. So what we're looking for is the price of oil to break out in a downward action, or we could get a reversal pattern and break out. It could end up moving up here and then breaking out this way. Okay. But we've got a beautiful wedge here by attaching the swing highs and the swing lows. And you can actually see it. If I didn't have the lines on there, you could visualize this, this wedge. Let me take you over to, I think I have another one up here with triangles for you. Okay, now here we're looking at another chart, and this is a lot simpler. We've taken a swing high, projected it out forward here, okay, and it's a support line and a resistance line are similar to drawing trend lines, except they don't have the same rules as trend lines. All you're doing is finding the swing highs and projecting it forward across those swing highs. Here you're finding the swing lows and bringing those forward on the swing lows. Now here we've already had the breakout. Okay. So here, as we moved into the center of this beautifully formed triangle, we have price breakout. And look at the drop in price here. Okay. And now it's starting to return back up to its original movement. Okay. Now, there are other things we want to look at when we're looking at swing highs and swing or breakouts, and we want to confirm them with volume. But these are how easy it is to see these beautifully formed patterns. Now here we're looking at a 30-minute chart. So if you were day trading or short-term trading, this would be the appropriate chart, and this would be the pattern you were looking at. Okay. With oil, we're looking at a one-day chart. So when you get your breakout, you're not expecting that price to move to the full distance of the breakout or the momentum in 15 minutes or a half hour. You're looking at that to move over the next probably 30 days. Okay, because each one of these highs and lows in this triangle, this wedge. So when it breaks that wedge, we can predict where it's going to go, but it's not going to reach its full potential for a while because we're looking at a one-day chart. If we change this to a shorter term chart by trying to move it back to our time frame, okay, we don't have a triangle or a wedge here at all to trade from because you see a different, completely different formation in a shorter time frame. So finding the triangle or finding the pattern has to fit the time frame in which you are trading. So let's go back to my PowerPoint for a minute here. Now, triangles are pretty simple. And I'll show you in a few minutes an easier way to locate them. Because remember, these all have some standard rules, and these rules can be written into numeric equations. And if you use a trend or chart pattern software, or you use investing.com, they'll point out where these formations are taking place. So you're only concerned with how price is ready to react when that triangle has formed, or that wedge is formed, or the head and shoulders completed. So you don't have to be looking for them. You can have software looking for them. You make the decision. Now, I don't personally trade. I look at those chart patterns, but I don't put 100% reliability in them. Yes, because common sense says when price gets pent up in the center, it needs to break out. Okay. Now, the one pattern that I follow and I believe in when it forms is a head and shoulders pattern. Head and shoulders is very common in the marketplace, not common in formation, but you hear people talk about it a lot. The reason being is it is a very popular pattern, and when it forms, it's a very reliable pattern. Now, a head and shoulders is exactly what it's called. It is two shoulders and a head. Now, the point where the support line is drawn is where the price forms the first shoulder is called the neckline. The shoulder, so you don't see it. You start to see it begin here because price moves up. You don't know the head and shoulder. Price then eases down to a level here and then bounces back up. When price bounces back up, and this level must be higher than that level. Now there are different strategies that tell you how much different the levels have to be. Okay. There aren't rules. Different traders use different qualifications. Okay. But for us, the qualification is that this next peak must be higher than the previous peak, and we're going to say by at least 15%. Then price will come back down, but still you don't know whether you have a head and shoulders. Price will come back down, and if price hits that same neckline, or actually forms the neckline now, because it's now supported this support line here, and bounces off of there, now you have the formation of a possible head and shoulders. When price moves back up and reaches almost or pretty much the same level as that previous shoulder and turns downward, then you know you have a head and shoulders formation. And you're now going to be looking for the breakout here. Okay. So you don't see, you can't, once you see the neckline established and you see this much of it established and you see price move down, now you're in a head and shoulders pattern and you're expecting it to break down and break below the neckline. Okay. In a downtrend, it is just the opposite. It's the inverse head and shoulders, upside down. Same rules apply, just flipped over top. Now, when you have this pattern develop, it is very reliable. Okay. And now there are some formulas that you can actually attach to these. Okay. Because my sketch of a head and shoulders was very easy to see. When it forms on a chart, okay, because price moves up and down continuously, you have to start realizing. So what you see is price move up here. Okay, price was in an uptrend, recover, price moved up. We have no idea head and shoulders about to form. Okay, so price moves up here. It has a peak. It comes back down and hits this support level, bounces back up there and goes higher than the peak. We still have no idea what's happening. Price goes back down and now it hits that same support line, and that becomes now the established, what's called the neckline. It bounces off of there and forms the right shoulder. Okay. Comes back down, and when it hits this level, it's generating a sell signal. Okay. Our target for where we would want to exit the market can be calculated. Okay. Because what this is telling you is that price has a momentum to it. Okay. And when it breaks out, we can calculate this by T equals N minus H minus N. So that the target price is the neckline minus the head minus the neck. So what you do is you would calculate, to reach this target, is you would calculate the price or get the price for the neckline. So say hypothetically, this was a zero. Let's use good numbers. 1, because I don't like using zeros. This was 2. Okay. We don't know what the target is, but we can drop these numbers into formula. So target would be neckline, which was 1, minus the head, which was 2, minus the neck, which was 1. So it's whatever prices are on the chart, you drop them in. So what you have is 2 minus 1 equals 1. 1 minus 1 gives you 0. So your target price would have been this level, which is 0. And then you could have set a trade. You could have put a sell signal here. You could have entered a sell here, taken your target here, and put a stop loss here. So you actually have something that will help you do some calculations. But by itself, a head and shoulders is not you need to use it with other complementing indicators. Again, volume is very, very important because does volume substantiate this move downward? Okay. And other indicators like MACD or something else that will support the move that tells you that's really a good move. So the given price is formed in an uptrend representing 3 peaks of the market price arranged at different levels. 2 lower peaks called shoulders are located at the 2 sides of the highest peak called the head. The pattern's lows are connected by supporting levels called a neckline. If this price falls below the neckline or support level, a sell signal arises. Though prices may rebound to the neckline forming a resistance level, it is expected that the decline will continue. So here, okay, you had the sell signal, you entered here. This is why you have to have your stop loss up here, because it doesn't mean it's going to move right away. See, it congested around the neckline and then finally broke down. But your sell signal was generated here. And when you see a true head and shoulders form, it is a pretty reliable signal. Also, you do the same calculation to everything upside down for a inverse head and shoulders. Now, the other patterns we form are multiple tops and bottoms. Multiple tops and bottoms I don't find reliable. Tops and bottoms form channels. Price moves up, hits the support line, comes back down to resistance line, moves back up to support line, falls back down to resistance line. This happens over and over and over in the markets. It might help you notice something, but unless you're using something like Japanese candlesticks or something else that will help you interpret this, it is very hard to use this as a trading signal. Okay. There's no rule that is going to break out how strong the breakout is, no matter what some strategist wants to tell you. Double tops and double bottoms to me are not reliable signals. You need triples. So triples become much more important. When price moves up, bounces off support, bounces up to resistance, bounces up to support, bounces up to resistance again, it is most likely getting ready to break that movement. Now, it can break down or it can break up. But when you have a triple formation, it is becoming more relaxed. All it did was take double and move it one more step. And it becomes much more reliable. And when you have a triple pattern, again, you have a mathematical calculation to help you predict or determine the momentum that should send you to your target. And it's pretty simple. T is equal to S minus H. Okay. You have your support line that is bouncing between. You also have your resistance line at the top. So it's simply the target price is the support minus the top or the headline. And it should be able to bounce down as far as that level. So, trends and breakouts. An important measure of the quality of the pattern, and this is very important, is the trend that precedes it. It does not matter whether the trend is bullish or bearish, but the consistency and the duration of the initial trend partly determines the well-formedness of the pattern. So if you're looking at triangles, wedges, you're looking, well, head and shoulders always don't really count it, but you're looking at channels. You have to look at it in conjunction to the longer term trend. Because when you have a weak initial trend, so in other words, prices moving in is very slow up and down in an uptrend, but very weak and not really well established. If it forms a pattern, the breakout momentum will be nowhere near what is expected. When you have a strong trend and a well-developed trend, your breakout and the momentum will be much more severe and much more calculable. So you always have to look at how strong the trend is. The pattern is said to have broken out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, it is called a continuation pattern. If the breakout is in the opposite direction, it is called a reversal pattern. For example, a pattern described as bullish reversal triangle would mean that it is a bullish signal. That is, the breakout was through the resistance line upward. So here we have price moving in an upward direction. It broke the resistance line and gave us a very strong breakout. Here we have a weaker breakout. And again, we're looking at, in this case, we're looking at a secondary. We're looking at how big that bar was when the price broke that channel. So that's telling us the story of the bulls and the bears and how strong they are at that momentum. Now, on your screen are the calculations that you can use depending on whether they're wedges, bullish, triangles, bearish, or whatever else. These are standard. You can find them all over the internet. Okay, these are no secrets. But when you draw your wedges on there, you can use these to determine your entry point, your exit point, and your target point. Now, depending on what type of trend you're coming off of and which type of pattern you're looking at, it could be a 1 or 1.5 move. So usually when you're looking at triangles, it is equal to 1.5 times the width of the triangle. When you're looking at sideways patterns, it's usually equal to 1 time the movement of the previous bounce between support and resistance. Okay. Now, let's go over, let me pop over and show you an easy way to get these. Okay, so you don't spend your time searching for these or getting lost with them. So hold on, let me pop up. Okay. So I'm going to take you over to investing.com. And you can get these all over the place. You can use auto chartist. There are all different, depending on whether you're trading on an MT4 platform, you're trading on a web trader. You can find there's all sorts of advisors that can be added onto your system, okay, and apps that you can use that will predict these. Investing.com, if you just go look under chart patterns, okay, and it depends on what the chart patterns for the assets you're looking at depend on what assets you have in your portfolio. Okay. So this will tell you right now with the Hong Kong dollar, Japanese dollar, in a 15-minute interval, at 9:15 Eastern Standard Time, a triangle formed. It broke out in a continuation pattern, and it's telling you how strong it's got. They've applied a mathematical calculation to how strong that is. Okay. For the person that keeps in writing, can you talk slower? I am not an actor. I am a trader and an analyst. I speak in my normal speech patterns. I'm very sorry if it's too fast for you. I also have to cover a lot of materials in a very specific amount of time. Okay. For any of you who want to come back and listen to the recorded version of this, it will be available after tomorrow by using the exact same link you had for tonight's class. Just click on that link and it will take you to the recorded version. But I cannot adjust my speech patterns depending on what part of the world you're from and how good your English is. I'm very sorry about that. Okay. Like I said, I'm not an actor. Okay. So we can see here that gold against the pound formed a triangle just recently. You also have emerging patterns. You have these are patterns that have just been completed, and you have to look at when they were established and when they were completed. And now we have also emerging patterns. Emerging patterns are patterns that are about to happen, that we're looking for them to develop now. So here we have the Swissy Japanese yen in a 15-minute time frame. At 9:30 Eastern Standard Time, it started to form a flag, and it's a continuation. It's taken over it's formed over the last 24 segments, and it's a 73% quality signal. So its advisory is to trade it going up, because that's what a continuation pattern. This was moving off of an uptrend. It broke out in a continuation pattern, where we can also see that we had the Swissy form an inverse head and shoulders earlier today as a continuation of flag, and it's over 120 time frame, and it's now broken into a reversal, and it's advising you also to trade upward because it was a reverse head and shoulders. Okay, I can't tell you, what does it mean by quality? Well, I don't know, so I would recommend that you go read the information at investing.com. Like I told you, there's all types of AEs that give you this. I'm not an expert on their system. You need to go do some of your own learning and research. Like I said, you can go Auto Chartist, and they have all of theirs. You can download Auto Chartist here, or you can follow. I don't know. This is not my system, so I don't know what the quality is, and I don't even know how the mathematical calculation's done, and I don't use the calculations. I use the patterns, and I look at the trend lines. But this is one way that you can find them, because I would not use any of this here. All I would know is if I was going to look at trade the Euro Japanese yen, that a flag or an inverse head and shoulders is developed, and I would go to my chart and put it on my chart, and then I would use it to make my own determination. All this is meaning is you don't have to stop and spend your life searching the market for these patterns. So it's just one of the tools out there. Like I said, there are many, many, many different ways that you can get these. Okay, so let's go back over to my PowerPoint. No. Okay. Now, when a pattern forms, we need to look and see whether it's a continuation. A continuation is a breakout in the same direction of the trend. A reversal is a breakout in the opposite direction of the current trend. So if it breaks out up in a downtrend, it's a reversal. If it breaks out up in an uptrend, it is a continuation. Okay. Now, we can also apply these very well with Fibonacci retracements, and they could help us. Because like I said, these patterns don't work. They give you information, but they're not a trading system on their own. So combining with things like Fibonacci retracement levels can help you work this out for yourself. Okay, so basically, again, we would look at the initial move and then the retracements, but we have to look at these other patterns, and these are patterns that are very important, and you have to be able to tell whether they're reversals, retracements, continuations, because it's important to be able to apply these to your trading decision. So again, using Fibonacci retracements are a very good supporting level to help when you see a breakout, because when you see a breakout, whether it's up or down, whether it's continuation reversal, you could then use the Fibonacci levels to set your targets to where you think the price might go or where the next price reaction could occur. Now, if you don't know how to use Fibonacci's, we have a whole class, we just had it the other day, on Fibonacci retracements, and join us for that class. But remember, if you use your trend patterns with a secondary and you also combine it by looking at volume at the same time, you can then start to feel confident that you're at least predicting the right price movement and establishing the momentum that might help you make a smart trading decision. So on that note, I'm going to say goodnight to you. Hopefully this just gave you something to think about, because you can't master this in just our simple class. Our simple class is to give you some food for thought. Now, you can go to the internet, because all of this is available. Do not go looking at people's trading system. Don't go looking at some guy's system that's going to tell you how to make money trading triangles. Go learn what a triangle is or a rectangle and how to evaluate it, and then watch it form on your own and come up with your own system. Trading somebody else's system or somebody preaching to you is they're just preaching to you. Learn how to find these yourself and evaluate them. And there are lots of good, easy to read information on the internet that can help you find the right things. But these are things to think about. Go back and maybe you want, or maybe just when you start reading things and you've heard about breakouts and triangles and you just want to know what they are. Hopefully now you know what they are, because not all of us trade from chart patterns. I use them when they developed and I see them, but I don't go chasing them down. But when I see them, I know what to expect, okay? Because I understand what is causing them. Okay. So there you have it. It's just a starting point for something for you to think about. And again, if you want to listen to the recorded version, just give it about 24 hours for it to get processed. And just use the link you used for tonight's class, and it will take you right to that recorded version. Have a good night now. Thank you for supporting CMS Trader, because also if you want to learn more about this, CMS has exceptional education right on their site. And you'll be able to use their demo account and use this along with their education right on their platform, and start to learn how to use this. So have a very good night now, and we'll talk to you again soon. Bye.